So, one of the first things that I got into when I first started investing was dividend stocks, right? Dividend investing. And I've had a lot of people ask me, like, why would I invest in dividend stocks when I could invest in, a company that is going to skyrocket in value and this and that and the other. And the more they talk about it, the more I feel like they have a misunderstanding or misconceptions about some of the good things and some of the bad things about dividends. I want to go over a couple of these, right? Because like I said, one of the first things most new investors like me learn is that dividend stocks they're good, right? They're a wise option. Generally thought of as a safer option than growth stocks or other stocks that don't pay a dividend, right? Dividend stocks occupy a few spots in even the most, novice investors' portfolio. Yet, dividend stocks aren't all the sleepy safe options that a lot of people have been led to believe. Like all investments, dividend stocks come in all shapes and colors and sizes, and it's all, it's important not to paint them with a broad brush stroke, right? Don't generalize everything. So I want to go over some of these, misconceptions about dividend stocks and get an understanding, right? Because understanding them should help, you choose better dividend stocks if you choose to do so. The first thing is high yield. High yield is best. Well, that's a really big misconception of dividend stocks. Many dividend investors simply choose a collection of the highest dividend paying stocks and hope for the best. For a number of reasons, that's not always like it's not the best idea. It's not a great idea. Let's look at an example. So let's take a look at Sure Dividend's weekly list of monthly dividend paying stocks. Now, when you screen that list by companies with the highest dividend yield, the top names are not always the top performers on a total return basis. If we go back to March of 2018, Corpus Entertainment is a top dividend yielding company with a dividend yield of 26.9%. However, it has a 10-year annualized total return of negative 1.81% and a 3-year annualized total return of negative 18.54%. So while it has the quote unquote best dividend yield, its total return it's lackluster. Remember, a dividend is a percentage of a business's profits that it is paying to its owners or its shareholders in the form of cash, also quoted as its payout ratio. Now, any money that is paid out in a dividend is not reinvested in the business. If a business is paying shareholders too high a percentage of its profits, it may be a sign that management prefers not to reinvest in the company given the lack of upside. Therefore, the dividend payout ratio, which measures the percentage of profits a company pays out to shareholders, is a key metric to watch because it's a sign that a dividend payer still has the flexibility to reinvest and grow that business. Some sectors of the market, they have a standard for high payouts, and it's also part of the sector's corporate structure. A lot of you know what I'm talking about. REITs, the real estate investment trust, and the MLPs, master limited partnerships, right? These companies have high payout ratios and high dividend yield because it's ingrained into how those businesses are structured, right? The second thing, dividend stocks are boring. Naturally, when it comes to high dividend payers, most people are going to think of utility companies and other slow growth businesses. These businesses come to mind first because investors too often focus on the highest yielding stocks. If you lower the importance of yield, dividend stocks can become much more exciting. Some of the best trades a dividend stock can have are the announcement of a new dividend, high dividend growth metrics over recent years, or the potential to commit more and raise a dividend, even if the current yield is low. Any of these announcements can be really exciting and can jolt the stock price and result in a greater total return. Sure, trying to predict management's dividends and whether a dividend stock will go up in the future, it's not easy, and there's a bunch of indicators. So let's talk about some of these. One of them I want to talk about is financial flexibility. If a stock has a low dividend payout ratio but is generating high levels of free cash, It obviously has room to increase its dividend. Low capex and debt levels are also ideal. On the other hand, if a company is taking out debt to maintain its dividend, watch out. The second thing to talk about here is organic growth. Earnings growth is one indicator, but also, you need to keep an eye on that cash flow and revenue, yeah? If a company is growing organically, right? In other words, increased foot traffic, sales, margins, then it may only be a matter of time before the dividend is increased. However, if a company's growth is coming from high risk investments or international expansion, then a dividend could be less certain. Which leads me into the third thing to talk about. Dividend stocks are always safe. Now, dividend stocks are known for being safe and reliable investments. Many of them are top value companies. The dividend aristocrats, which are companies that have increased their dividend annually over the past 25 years, are often considered safe companies. When you look at the S&P 100, which provide a list of the largest and most established companies in the U.S., you also find an abundance of safe and growing dividend players, right? However, just because a company is producing dividends doesn't always make it a safe bet. Management can use the dividend to placate frustrated investors when the stock isn't moving. In fact, there's a bunch of companies who have actually done this. Therefore, to avoid dividend traps, it's always important to at least consider how management is using the dividend in its corporate strategy. Dividends that are consolation prizes to investors for a lack of growth are almost always bad ideas. We can look back in 2008. The dividend yields of many stocks were pushed artificially high due to stock price, declines. Now, for a moment, those dividend yields looked really tempting. But as the financial crisis deepened and profits plunged, many dividend programs were cut altogether. A sudden cut to a dividend program often sends, stock shares tumbling. Is exactly what happened with bank stocks in 2008, just all the way to the bottom. So what do we learn from all this? What's the bottom line? What's the lesson here? Well, ultimately, investors are best served by looking beyond the dividend yield at a few key factors that can help to influence their investing decisions. The dividend yield, in conjunction with total return, can be a top factor as dividends are often counted on to improve the total return of an investment. Looking only to safe dividend payers can also significantly narrow the universe of dividend investments. So if you're going to invest in dividends, and I say this about any type of investment you're going to do your research, and make sure, when you get ready to do something, put your money in something, it's for, how you want to invest for your goals, because what you want is different from what someone else wants, right, guys? Hopefully you guys enjoyed this video. If you did, go ahead and smash that like button. If you're not subscribed to the channel, I'd appreciate it if you did. But till I see you guys in the next video, y'all be safe.